Good morning, everyone. Today, we're diving into a topic that could profoundly impact your financial future and the very stability of the global economy, the looming debt crisis in the United States. Billionaire investor Ray Dalio, the founder of Bridgewater Associates and widely regarded as one of the greatest macro investors of all time, isn't just warning us, he's sounding a dire alarm, comparing America's debt burden to an economic heart attack. This isn't theoretical fear-mongering. Dalio correctly predicted the 2008 financial crisis, and his latest insights, detailed in his new book, How Countries Go Broke, The Big Cycle, suggest we're rapidly approaching a point of no return. What exactly is going wrong, and what does it mean for all of us? Dalio vividly explains the credit and market system as being akin to the human body's circulatory system. He says it's designed to bring vital nutrients, or in this case, credit, to all parts of our markets and economy. When this system functions efficiently, that credit fuels productivity and income, leading to growth and prosperity. It's a fundamental mechanism for a healthy economy, allowing individuals and businesses to invest, expand, and generate profits that then cycle back through the system. However, the problem arises when this credit isn't used productively or when debt begins to accumulate at an unsustainable pace relative to income. Dalio likens this accumulation of debt service to plaque building up in the circulatory system. Just as plaque restricts blood flow and can lead to severe health issues, excessive debt payments begin to squeeze out other essential spending within the economy. This can slow down economic activity and critically hurt the bond market, which is usually the quiet bedrock of the US and global economies. This plaque accumulation leads directly to what Dalio describes as a potential debt death spiral. Imagine a scenario where the government needs to issue more and more bonds to raise money just to cover its existing debts and burgeoning interest payments. But because the debt burden is so massive and appears increasingly risky, investors become less willing to buy these bonds, or they demand increasingly higher compensation in exchange for what looks like a riskier loan to the U.S. government. This dynamic creates a vicious cycle. Rising interest rates lead to worsening perceptions of credit risk, which in turn lead to even less demand for the debt, ultimately pushing interest rates even higher. The consequence? Higher interest rates demanded by investors leave less and less money available for running a country, funding essential public services, or investing in future growth. Furthermore, these rising rates for government borrowing tend to increase interest rates for consumers and businesses across the board, further dampening economic activity and leaving the country with fewer options to raise cash. The underlying numbers underscore the severity of the situation. According to data cited in the sources, the ratio of federal debt to gross domestic product, or GDP, has surged dramatically. In 2017, this critical ratio stood at 104%. By 2024, it had ballooned to 123%. This is a staggering increase and represents levels of deficits and national debt to GDP ratio that are, as one economics professor noted, unprecedented except for recent recessionary times. This highlights a structural problem that is becoming increasingly difficult to ignore. Current U.S. President Donald Trump's economic agenda, particularly his tax bill and tariffs, are significant factors contributing to this alarming trend. His big, beautiful tax bill, while cheered by the stock market during his first term, is designed to slash tax revenues without implementing sufficient spending cuts to balance the budget. This imbalance is directly adding to the deficit at a time when the federal debt burden has already ballooned to critical levels. Investors are increasingly concerned that these policies could further pressure the federal debt burden, especially amidst existing uncertainties about the economic outlook and the appeal of U.S. assets. For instance, in May, the rate the U.S. government had to pay investors for a 30-year loan spiked to its highest level since 2023. This reflects investor reluctance and a demand for higher compensation due to the perceived risk of lending to the U.S. government. Beyond fiscal policies, Dalio comments on President Trump's approach to governance. He notes that Trump wants to dictate policies rather than pursuing a collaborative across party lines approach. Dalio warns that Trump's attempts to maximize presidential power by bypassing other branches of government are analogous to methods used by historical figures like Andrew Jackson and Franklin D. Roosevelt, though he considers Trump even more aggressive. Dalio explicitly asks if Trump is a demagogue, defining one as a political leader who gains power by appealing to emotions, fears, prejudices, and promising easy solutions. He suggests that Trump's strongman style is a symptom of America's deeply polarized politics. While the situation is grave, Dalio offers a nuanced perspective on the immediacy of the crisis. He clarifies that there is a very low imminent risk of a U.S. government debt crisis right now. However, and this is the crucial part, he states there is a very high long-term risk. This means the problem isn't going to explode tomorrow, but it's steadily building up, creating conditions for a sudden and severe disruption down the line. Dalio notes that this progression has occurred many times throughout history, yet policymakers and investors often mistakenly believe their current circumstances are unique and that their monetary system won't change. He warns that such a fundamental change, though currently unthinkable to many, then it happens suddenly. He attributes this lack of understanding to the rarity of such events in reserve currency countries, happening perhaps only once a lifetime. So, what can be done to avert this potential economic heart attack? Dalio proposes what he calls his 3% three-part solution. The core idea is to get the budget deficit down to 3% of GDP. This is a critical threshold to restore financial stability and prevent the spiral from intensifying. This ambitious target, similar to efforts made between 1991 and 1998, where the budget deficit was cut by 5% of GDP, must be achieved by spreading the burden across three key areas. These three things are cutting spending, increasing tax revenue, and lowering interest rates. Dalio stresses that any one of these measures alone would be too painful to implement politically and economically. Therefore, a balanced approach, distributing the necessary adjustments across all three levers, is essential for successful implementation. This supply and demand problem in the bond market is a central concern. Dalio highlights that not only is there a current imbalance where demand is being reduced relative to supply, but there's a risk that existing bondholders around the world could begin to sell off their holdings. If bondholders start to worry about the value or security of these bonds, the amount to be sold could far exceed even the volume of new debt being produced. When faced with such profound supply-demand imbalance, a government typically has two primary unpalatable options. Either interest rates must skyrocket to attract buyers, making debt servicing even more expensive and squeezing out other spending, or the central bank must step in and print vast amounts of new money to purchase the bonds. This money printing might alleviate the immediate demand problem for bonds, but it comes at the cost of devaluing the currency, leading directly to higher inflation and eroding the purchasing power of citizens. Dalio unequivocally states that these necessary adjustments, which are designed to bring the system back into balance, should ideally result from good fundamental adjustments agreed upon and implemented proactively, rather than being forced by a crisis that leaves no other recourse. Given this challenging outlook, Dalio provides specific advice for investors seeking to protect their assets and even thrive. His primary recommendation is to diversify well across different asset classes and countries. This means not putting all your eggs in one basket, particularly within a single currency or economy that faces long-term structural issues. More specifically, he suggests underweighting debt assets, such as traditional bonds, due to the inherent risks associated with rising interest rates and potential dilution of bondholders. Conversely, he advises overweighting tangible assets like gold and even holding a bit of Bitcoin. Dalio views gold as a powerful hedge against debt crises and currency devaluation. He believes that even a small percentage of one's portfolio in gold can not only reduce overall overall risk, but potentially enhanced returns during volatile times. His inclusion of Bitcoin, a relatively newer asset, reflects a recognition of its potential role as a digital hedge in a world grappling with traditional financial system vulnerabilities. For skeptics who point to Japan as an example of a country with high debt that hasn't collapsed, Dalio offers a stark counterargument. He notes that while Japan hasn't faced a complete collapse, Japanese bonds and debt have been terrible investments. Since 2013, holders of Japanese bonds have experienced losses of 45% relative to holding US dollar debt and a staggering 60% loss relative to holding gold. Furthermore, the typical wages of a Japanese worker have fallen by 58% when compared to the wages of an American worker. This demonstrates that while a full death spiral in its most extreme form might be avoided, the consequences of unsustainable debt can still be profoundly detrimental to a nation's economy and its citizens' quality of life.
The political gridlock preventing a resolution to this debt crisis is perhaps one of the most disheartening aspects of Dalio's assessment. Despite the grave warnings from financial titans and clear statistical evidence, both the Democratic and Republican parties, as Dalio points out, seem to agree on the necessity of addressing the nation's burgeoning debt. However, this consensus evaporates when it comes to the practical implementation of solutions. Dalio offers a poignant and frustrating analogy. It's like being on a boat that is undeniably headed for rocks, and while everyone aboard recognizes the danger and agrees that they should turn, the crucial and debilitating obstacle is that they can't agree on how to turn. This inability to forge a bipartisan path forward means the problem continues to fester, growing larger and more intractable with each passing day. The longer this political paralysis persists, the more difficult and painful the eventual necessary adjustments will be, pushing the country closer to the precipice of a sudden and potentially catastrophic economic shift. Dalio anticipates that the United States will be in a critical situation within approximately 3 years if these issues are not addressed. This is not a distant future problem. It's a rapidly approaching deadline that demands urgent attention and decisive action from policymakers. The longer the delay, the more severe the eventual consequences are likely to be. Dalio's concerns extend beyond mere financial metrics to the societal impact of potential austerity measures and economic instability. He warns that cost-cutting measures, especially those that disproportionately affect vulnerable populations, are likely to have negative consequences. He states that many people who will be hurt by them will fight back, and valuable support systems will be weakened or eliminated. As an example, he mentions his own wife's work helping low-income students who depend on school lunch programs, highlighting how the cancellation of such programs will have terrible second-order consequences. He also reflects on President Trump's policies, which he sees as aiming to move more money, power, and freedom into the hands of the most productive people. While acknowledging the difficulty of managing a country that has been mismanaged and in such a mess, Dalio emphasizes the importance of considering the well-being of all citizens. He recommends regularly checking on how those in the bottom 60% are doing and feeling, stressing that a healthy democracy relies on broad well-being, not just the prosperity of a few. This holistic view underscores that an economic crisis is never just about numbers. It has profound human and social costs. The warnings from figures like Ray Dalio and JP Morgan Chase CEO Jamie Dimon, who recently stated that a crack in the bond market is going to happen, are not to be taken lightly. The bond market, which underpins the entire financial system, is showing signs of stress, with the U.S. long bond approaching levels not seen since the 2008 financial crisis. Analysts from firms like Barclays also anticipate that continued rising deficits will drive up long-term yields, further complicating the situation. In essence, we're being presented with a clear diagnostic, backed by measurable trends that suggest serious problems are approaching. The credit system, so vital to our economic health, is under immense pressure, and the consequences could be far-reaching. The imperative for action is clear, but the path forward remains clouded by political divisions. Your ability to navigate these turbulent waters will depend on understanding these dynamics and making informed decisions about your financial future. Thank you for joining me today to explore these critical economic insights. I hope this discussion has provided you with a deeper understanding of the challenges ahead and what you can do to prepare. Stay informed, stay diversified, and I look forward to our next conversation.